Yeah, so that's it. I want 100 shares of Stretch Rubber Band Company at $20 a share or better.
Okay, I'll get back to you to confirm.
Thank you, good. What I have just done is I have put a stock deal in motion. This is done every business day, just like that, by millions of investors all over the country. But after you hang up the phone, then what happens? I told my broker just now to buy 100 shares of Stretch Rubber Band. After I get off the phone, he telephones one of the nation's several stock exchanges. Let's say in this case it's the New York Stock Exchange. My order is relayed to a specialist on the exchange floor. He handles all the buy and sell orders for Stretch Rubber Band. He matches them up, he sets the price, and if there is another investor out there who is willing to sell me Stretch Rubber Band at $20 a share, I have got a deal. The specialist then relays the message back to the broker, and
Bob, this is Chet. You've bought 100 shares of Stretch Rubber Band Company at $20 a share.
Listen, hold on a sec. They will always repeat the exact terms of the deal. Exactly. After all, I am making a $2,000 purchase, and they do want to make sure that I've got the terms precisely right. Chet, Chet? Busy man. All right. The deal is now set. But what exactly did I buy? Well, I'm going to show you a stock certificate. This is what they look like. And it says here that I bought 100 shares. That's my name on top, 100 underneath. This represents a portion of ownership in the Stretch Rubber Band Company. I am now a partner in this company, along with millions of other shareholders of Stretch. So my 100 shares represents just a tiny portion of ownership, but I am an owner nevertheless. I have a right to vote on important issues facing the company, including management. If it's a good year for Stretch Rubber Bands and the company makes money, I have a right to receive a dividend payment. But what's most important, and the real reason that I bought this stock, is that if the value of these 100 shares goes up, and I'm kind of hoping that they will, I can sell them for a profit. That is why I invested in the stock market. The market is a great way for me to build up my nest egg, to build my capital, but it does the same thing for companies, and that is why they issue their stock in the first place. I want you to look at our fictional company. This is the Stretch Rubber Band firm. It is a business made up entirely for this course, but it'll give you a real idea of how these things work. Now, here's the story of how Stretch got started. Back in the year 1870, a young Dutch immigrant named Johannes Strijge started the firm. He was a young scientist, and he had been experimenting with rubber. During the Civil War, he had tried to make and sell rubber bottles. But one day while eating lunch in a local bakery, he accidentally dropped his bottle into a bread slicer, slicing it into a dozen circular strips, much like this example here. This gave him an idea. Like many real entrepreneurs, Strijge took this thing to some financiers, in this case in New York. They liked it, and the firm was launched. That's how a lot of companies start. But after a while, Strijge wanted to expand the plant and hire more people. Now, to do that, it turns out, would have cost about $1 million. He didn't have the money himself. But he could go either to a bank to borrow the money, or he could go to you in the public, and invite you to become partners in his business by selling shares for cash. And in 1898, that is exactly what Johannes did. By that time, I should mention, the family had changed its name to Stretch, because that sounded a little more American to them. The Stretch Rubber Band Company sold 1 million shares at $1 a share and raised $1 million, built the buildings. Every share that is now trading on the country's various exchanges was originally sold to the public by an individual company. That's why companies get into stocks. They want your money. But what about you? Well, you can make those stocks work for you, building your capital. You may not make a fortune. The market does not make everybody rich. But if you work at this, you can learn to invest for profit. But first, you've got to know where to buy and where to sell. Basically, there are two markets where stocks and bonds are traded, the securities exchanges and the over-the-counter or OTC market. Let's take a look at the security exchanges first. The largest and the most important is the New York Stock Exchange, the big board. The big board accounts for more than half the annual value of all stock trading in the country. Generally, the country's biggest companies are listed on the big board, but number two is the American Stock Exchange. And then there are regional stock exchanges, including the Midwest Stock Exchange in Chicago, the Pacific Stock Exchange in San Francisco, and the Philadelphia Exchange. All these exchanges are similar because at each one, all of the trading goes on in one central location. The over-the-counter market, though, is different because there's no one place where the buying and the selling takes place. The stocks are not literally sold over the counter like at a drugstore. Instead, there are hundreds of separate dealers and brokers making lots and lots of deals all over the country. These transactions are increasingly centralized by a computerized system called the National Association of Securities Dealers Automated Quotation System, or much more simply, NASDAQ. On the over-the-counter market, you'll find a lot more companies than you will on any of the securities exchanges. Generally, they are smaller and they're newer companies. No matter where you want to trade, either over-the-counter or at the big exchanges, you're going to do it through your broker. Your broker is going to play a vital role in your investment life, so you should think carefully before you choose one. So you're probably asking yourself, how do I find a good one? Well, probably the best way is to ask a friend, the same way you would if you were looking for a good doctor or a good lawyer. But keep in mind that there are two kinds of brokers, and we've brought a pair of brokers here into the studio with me. One of them is a full-service broker. The other is a discount broker. See if you can figure which is which. I've decided to make her my full-service broker. Now, let me tell you about her. First of all, she's going to charge me more money. On the other hand, she's going to do more for me. A full-service broker normally has a research department. The researchers in that department keep tabs on companies all over the United States. She gets to know a lot of firms. She gets to know them well, and then she can make recommendations to me on what I should buy or what I should sell. She also bothers me a lot. She calls me all the time. Now, don't forget, a full-service broker makes a living on commissions. She wants me to buy and sell all the time because every time I do, she makes money, whether I make money or not. So even if you use a full-service broker, don't depend entirely on her advice. But this guy, the discount broker, a whole nother thing. He is considerably cheaper than she was. He works for commissions, but they're much less than the full-service commissions, sometimes half the price. On the other hand, all he does is place orders for me. He won't give me any advice. He won't even look at me. But I have to know what I want to buy and what I want to sell, and if I do, he'll do it for me. All right, let's say you found your broker, either one. Now you got to know how to talk to her or to him. So let's go back to that stock deal I made a few minutes ago, and this is how it all started out.
Trading.
Hi, can you give me a quote on RUB?
Just a minute.
RUB is the symbol of the stretch rubber band company on the New York Stock Exchange. So what the broker's doing right now is he's punching that symbol into a computer, and then the computer is going to display the current price. Yep.
RUB is 20 and a quarter, up a quarter.
Now that means that the current price for the stock that I want is 20 and a quarter, or $20.25, up 25 cents, literally a quarter since yesterday. Now, I got to decide what to do. If I think that 20 and a quarter is too high a price to pay, I can do nothing. But if I really want this stock, and if I think that the price is moving up fast, here's what I do. Hi, I want 100 shares of RUB at the market. Now, excuse me, that phrase, at the market, means that when my order reaches the exchange floor, I will pay whatever the market price is then. If at that time it's gone up to 22 and a half, I'm going to have to pay 22 and a half. But there is a second way to order stock. Suppose I'm on a budget and I can only spend $20 a share for the stock. Or suppose I think that the price sometime later today is going to dip down. Now here's how I order them. Hi, I want 100 shares of RUB at $20 or better. This is called a limit order. I've just put a limit of $20 on the amount that I would pay for each share of stock. Now remember, I said or better. Better for me means the price goes down. So if the going price falls today to $20 or less, I get the stock. If it stays above 20 bucks all day, I'll lose out on the trade. But at least I'm protected from spending more than I want to. Now don't run out now and order a lot of stock. We're not quite ready. Before you buy, you've got to think about your personal financial life. Now, how does investing in stock fit in? You need to know where you are now financially and where you want to be at some point in the future. And that brings me to the 3 principles of investment planning. Number 1, take inventory. Number 2, establish a reserve fund. And number 3, diversify. Let's take the personal financial inventory first. We have prepared for you a list of personal assets. Check out these items: cash, that's your salary, money in the bank, personal property, your investments. Total all these things up, and then look at the bottom line. That is how much you've got. Now you look at the other side of your financial life. This is what you owe, your personal liabilities: rent, credit cards, insurance, loans. You might add to this list any new debts that you'll be adding in the next year or so. And when you compare your assets and liabilities, you'll be able to see how much money you've got that isn't tied up, your liquid assets, which gives you some idea of how much you've got to invest. Now on to the second principle, establishing a reserve fund. A safety reserve is a pool of cash or cash assets that you do not invest in stock. The safety fund is there so that if you lose on your investment, if you put a lot of money on a stock and you lose it all, you won't lose everything, because you have another pile of money that you are keeping just in case. Very safe money, perhaps in a bank certificate of deposit or in U.S. Treasury bills, so when you need it, it's there. Now, how large this reserve fund is depends on your own particular circumstances. But a good rule of thumb is keep at least 20% of your capital, 20%, free at all times. Finally, diversify. This is really just common sense, but you'd be amazed at how many people there are who don't do it. Now, in the stock market, you're going to have lots of choices. Don't put all your money on just one stock. Now, follow this rule always. The larger your stock fund gets, the more important it is not to bet on one stock. So those are the 3 investment principles. Now, we've covered a lot of territory, and this is just the first segment, so I'm going to pause now, and I'll see you in segment number 2.
You are most likely to find newer, smaller companies listed on the New York Stock Exchange. True or false? False. You are most likely to find newer, smaller companies on the over-the-counter market. If you only want to spend a certain amount of money for a stock, what type of order should you place? A, a market order. B, a buy order. C, a limit order. The correct answer is C, a limit order. What are the 3 principles of investment planning? The 3 principles of investment planning are: 1, take inventory. 2, keep a reserve fund. 3, diversify.
Come here for a second, a little closer. There's something I want to tell you now. Somebody is bound to come up to you sooner or later and say something like, you gotta buy stretch rubber band stock, very hot stock. Don't do it. Tips and rumors lose you money. If you come into the market buying up stocks randomly in companies you know nothing about, you might as well go to Las Vegas. If you want to be a successful investor, don't guess. Investigate. Take a good hard look, ask a lot of questions before you buy any stock, and the most important question in any transaction is why? Why buy this stock rather than any other? Why buy Stretch Rubber Band and not Goodyear or Firestone? To answer those types of questions, you've got to devise an investment strategy for yourself. And basically, there are two methods for making money in the market: investing and trading. Investing is buying stock for the long haul. You buy shares in a company and you hold on to them, giving the company and the stock time to grow. Trading, that is buying and selling stocks quickly. You get in, you get out rapidly. You look for the short, quick price jump, you make your profit. Trading takes a lot of skill, it takes a lot of nerve. Most people are going to do better investing for the long term. Now, once you have a strategy, you're ready to start examining a particular stock, and you have to ask, is it a good buy? Will it grow? Is it safe? Your first step should be to investigate the industry. Look at the business you're getting into. Is it a growing or declining industry? If the industry makes a product that fewer and fewer and fewer people want anymore, then it probably will not be a good investment. Is it a boom or bust industry? Most industries are affected by the ups and the downs of the economy. Luxury items may do poorly in bad times, while necessities, they just keep on selling. Now, how has your specific industry done in past recessions, in bad times? Step number 2, investigate the company. If the industry's okay, what about the specific firm that you're interested in? Does it have a big market share or a small one? Has it been gaining or has it been losing ground in the past few years? Is the company's management a group of experienced professionals, or are they amateurs? A group where the president gets his job from his brother-in-law and then he hires his best friend. Company strength depends. It rises or falls on management. And most important, does the company make money consistently and reliably, or do profits come and go? Step number 3, investigate the stock. Now, this is probably the most important step because this is where you really find out what you're getting for your money. Now, it is pretty tough to evaluate a stock without playing with some numbers, so I've got my trusty computer here. For those of you who aren't mathematically inclined, don't worry, the presence of a computer should not bother you. It's going to be very simple. What I want to do is find out 4 things about any stock. Number 1, I want to know its price history. Number 2, I want to know its dividend record. Number 3, I want to know the yield of my stock. And finally, I want to learn its price-earnings ratio. Now, let's take them one at a time. First, the price history. Price history is really very simple. It asks the question, how much does a stock cost now, and how has the price fluctuated over the years? A stock's price never stays the same. It goes through cycles with periodic highs, periodic lows. Frequently, these cycles establish a clear pattern. There are no rules, but if you know the price history, then you have a better chance of figuring out when the stock is a good buy. Number 2, this is the stock's dividend record, or record of dividend, which simply asks, how many years running has the stock paid a dividend? Or has the dividend been the same, or does it go up and down all the time? Does it pay good dividends during recessions? What portion of the company's profits are paid out in dividends, and what portion is plowed back into the company? Now, number 3, what is the yield of the stock? Well, this is especially important if you're buying stock primarily for the dividend. The yield compares the dividend a stock is paying to the price of the stock. Now, let's say that it's paying $1 and it costs $10 per share. The yield in this case is 1 over 10, or as our computer has just told us, 10%. If it was paying $1, but it cost $20 to buy a share of the same stock, then you get a very different yield, a poorer one. You see here, computing it out, it's 5%. All right, number 4. This is the most important. This is the price-earnings ratio, or as it's known in the biz, the PE. Stock people talk a lot about price-earnings ratios. They're a way of answering the most difficult question about a stock. Is it worth it? Is it a bargain, or is it overpriced? Now, we decided to bring in some help for this section. The computer isn't quite enough, so for a moment, forget about stock, and I want you to think chicken. Now, let's say I'm about to buy or interested in buying this chicken. It has a reputation of being a fabulous egg producer. I am told it lays 4 eggs a week, but let's take a look and see. Here's where the eggs come out. Here is the egg-producing button. 1 egg. 2 eggs. 3 eggs. 4 eggs. Hey, fabulous. That's enough. All right, 4 eggs. And I'm told, by the way, that they can each sell for $1 apiece. This gives this chicken an earning power, as you've just seen, of $4 a week. So I have to ask myself, how much would I pay to have a chicken like this? The owner, as it happens, is asking $40. Now, if you compare that price, $40, to the earnings, $4 a week, you can see that the asking price for the chicken is 10 times the weekly earning power, which frankly doesn't seem all that unreasonable. Now, let's do the same for a stock. The price-earnings ratio works pretty much along the same lines. First, you've got the P in price-earnings ratio. That's the price of the stock, which is very easy to find. I just look in the paper. When I bought stretch rubber, the price was $20. So we then go to E, which is the earnings per share, which is really just a way of expressing how profitable a company is on a per-share basis. Now, the Stretch Rubber Band Company has 1 million shares of stock, and it recently posted a $2 million profit for the year. So the earnings per share of Stretch, again, you can do this on a pad or pencil. We'll do it here on the computer. You can see that it's $2 per share. Now, that's not money that the shareholders actually get. It's just a way for financial types to talk about profits. Companies release these numbers every 3 months. You can get them from your broker. But to get the price-earnings ratio, what you want to do is divide the price of the stock by its earnings per share. Stretch's price, as we've told you, was $20. The earnings per share is $2. So if you divide 20 by 2, you'll get the PE, and here it is. Voila, it is 10. Now, once you know what the PE is, you have to ask, how do you know if it's a good PE? Well, that's a little difficult to say because different industries have different standards. A good PE for a computer company might be a terrible PE for a rubber band company. Traditionally, for companies that were well-established, big companies, low PEs around 10, 11, 12, 13, they are considered good. But with companies that are growing very fast, where earnings are expected to grow in the future, especially the high-tech firms, the Intech, Protech, Teltech, those kind of companies, higher PEs are accepted. Remember, when people talk about PEs, what they're basically talking about is whether a stock is undervalued or overvalued, or as Goldilocks would say, priced just right. Now, you have to make that decision yourself, but using the PE is a very useful guideline. Now, step number 4, where to investigate. Where do you get all the answers to all these questions? Well, there are lots of places. Use all the sources you can get your hands on. That's what the professionals on Wall Street do, and they are usually the first to know of new developments. Your broker is obviously one source of useful investment information. There are also investment services and books and manuals on investment and scores of periodic investment letters and charts and bulletins. You can get a lot of information from these financial periodicals and from the financial pages of these newspapers. 2 especially comprehensive services that you have heard of, I'm sure, but you've never seen are this one, the Standard & Poor's Stock Report, and this one, which is Moody's. In this case, they're industrial news reports. Now, I'm going to show you a page from Standard & Poor's. Okay, this is the General Motors Corporation, and as you can see, you can find the company's most recent quarterly earnings and its earnings per share, and both these numbers are compared to last year's earnings, so you can see changes over the year. The Standard & Poor's also gives you important news about a company's products and its management and its stock. This is a very valuable investment tool. And finally, there is the most important source of financial information, probably the best investment tool of all. That is the financial report of the company itself. It's so important that we've devoted the whole next section to showing you how to read one.
What are 3 things to investigate before you buy any stock? You should always investigate the industry, the company, and the stock. A company that has 4 million shares of stock and made $1 million in profit has an earnings per share of $4. True or false? False. It has an earnings per share of 25 cents. Earnings per share is the amount of profits divided by the number of shares. If you take a stock's dividend and divide it by the stock's price, you get A, the price-earnings ratio, B, the market price of the stock, C, the yield. C is the answer. You get the yield.
All right, now comes the tough part. We are going to show you how to read a corporate report. Each time you buy stock in a company, there are some things you want to know. You want to know if the company is financially sound, so it doesn't go bankrupt on you. And you also want to know if the company is going to grow and become profitable, because the more money a company makes, the bigger it gets and the higher your stock's price will rise. Now, you can determine both soundness and growth from a corporation's financial report. Every company whose stock is traded on the stock exchange must open itself to examination by you in the public. The corporate report is a maze of tables, columns, figures, but to make things simple for you, we have chosen the two most important parts, the balance sheet and the income statement. So, I'm going to take a walk and check out a balance sheet. To determine a company's financial soundness, you have got to look at the balance sheet. And what we're going to do here is dig for something called working capital. Now, this here is a balance sheet for the Stretch Rubber Band Company as of December 31st of last year. And I want you first off to notice that this balance sheet on both sides has two sets of columns. One is labeled this year, the other last year, and on all balance sheets you're able to get an idea of how the company's performance compares from one year to the next. Now, there are two sides to the balance sheet, and they always balance. On the left are the company's assets, and over here on the right are the company's liabilities, and down here is something called stockholders' equity. In order to find out whether this company is safe, I'm going to take you through the full thing, starting with the assets, of which there are many kinds. The first one you will recognize because it's an asset that you have, I hope, you had in order to buy this cassette, money. Most companies have some money, and cash is a principal asset in all firms. Number two, this you probably didn't know. Lots of companies take some of their money and buy stock or marketable securities. It's a convenient way for them to park their cash until they need it. Now, third item, accounts receivable. Remember, this is assets, what the company has. Well, we have lots of invoices. Customers of Stretch currently owe our company for shipments of rubber bands that they got but they didn't pay us for. That's one example. In any case, it comes to $4 million. Number four is inventories. This is our graphic notion of a rubber band. Raw material is very important in our business, and we have lots of finished rubber goods as well on hand in our factory, ready to use, ready for sale, but we haven't shipped them yet. Stretch may have several shipments of raw rubber in inventory, bales and bales of different sizes of rubber bands ready to go when the orders come in. But for the moment, they are assets in our company, our rubber bands, if you will. Now, you take all these four things together, and you've got total current assets. What we have right now. Fifth category is something a little heavier, literally. Our fixed assets. This is the famous Stretch Company factory building. It also includes our land, our machinery, our office equipment. These are assets that our company uses over and over and over again to make the beautiful rubber bands that have made us famous. But let me tell you that all of these items wear out. They are adjusted on the balance sheet, consequently, for depreciation, because their value decreases as they're used up. In addition to current assets and fixed assets, we've got two other very minor categories. This one here is called prepayments and deferred charges, and that's just, it's like items you pay for at the beginning of the year, like insurance, whose benefits come to the company over the next few years. And down here are intangibles, That would be trademarks, patents, even the goodwill, Stretch's name, very, very marketable commodity. Taken all together, these are Stretch's total assets. Now we turn to the liability side of the balance sheet. These are all the debts that the company owes or that are expected to come due over the coming year. There are 5 categories of liabilities, and I have them all in my pocket here. The first one is the accounts payable section or category. This is the amount of money that the company owes to its suppliers or to anybody that it buys things from. Now you'll see here, if you look, the company bought $2 million of something, probably rubber, from somebody, probably Malaysia. Number 2 is notes payable, which is a fancy way of saying that the company owes money to a bank or other institutional lender. All right, that's the IOU section. Number 3 is accrued expenses, another fancy phrase simply to describe the salaries that the company owes its president and its workers and its attorneys, the money it owes on insurance premiums, pensions, normal expenses, which of course it pays for on these lovely green stretch rubber checks. And finally, there is the income tax. All companies, if they have a profit, must pay one, and that is true of this company as well. Taken together, these 4 are called the total current liabilities. In addition, of course, Stretch has some long-term liabilities, debts that are due sometime in the next year. Altogether, we've got total liabilities, everything this company owes. Now, the big question. Given what we've learned, is this a safe company? Or, to ask it more precisely, what is its working capital? Okay, let's zero in on just 2 categories. You can do this on any balance sheet for any company. The total current assets, everything that the company has right now, and the total current liabilities, everything the company owes over the next year. Working capital is the difference between these 2 numbers. The amount that Stretch has left over if it pays off all of its short-term debts would be the working capital. Or, $12 million is what it's got, $5 million is what it owes. That leaves a working capital figure for this company of $7 million. Is that enough? That depends on the size of the company, the business it's in. But let me give you a simple formula to help you make a judgment. Many analysts believe that the ratio of current assets to current liabilities should be at least 2 to 1 if the company is safe. 2 to 1. Well, 12 million over 5 million is better than 2 to 1. That's 2.4 to 1, which makes Stretch look pretty safe. Now, before we move on, I want you to take one more look at this side of the balance sheet. If you take all of these liabilities, all of them, this one and this, and subtract them from all of the assets, the number you come up with is something called stockholders' equity. If somebody comes along and says to the Stretch Rubber Band Company, okay guys, I want you to pay off everything you owe, get rid of all your debts, what would you have left? You'd have the bedrock of the company. That is stockholders' equity. And clearly the larger the stockholders' equity, the stronger the company. It's over here on the liability side for a very simple reason. A balance sheet has to balance. Now, if this company were doing well, there ought to be more weight on the asset side. If liabilities are equal to assets, then the company's owners would have nothing and would have to go out of business. By putting the stockholders' equity over here, which is really just assets after liabilities, then a healthy company balances out. Okay? That shows you if the company is going to be a safe investment. Now, if we want to find out if the company is going to grow, is it profitable, is it going to make more money in the future, and I think we do, for this we're going to have to dig out something called the company's operating margin of profit. And to find that out, I'm going to go down the hall to look for an income statement. One more thing here. Don't get income statements mixed up with balance sheets. The balance sheet reflects the financial status of a company on a precise day. It's kind of like a snapshot. The income statement focuses on profits and losses over a period of time, usually a year, sometimes 3 months. Why don't we go look at one? Actually, the income statement is really very simple. It compares how much Stretch or any company took in last year with how much it spent to make its products. Now, it's not just 1 year of figures. You can look over there and see that there are 2 years, last year and this year, for comparison. The top line on this chart is net sales right here, which is the main source of the company's income. In this case, it's the money made from selling rubber bands. Right underneath this item here is everything that the company paid to make those rubber bands, which includes employees' wages, depreciation, executive payroll, sales, promotion costs, you name it. If it's a cost, it would be right along here. When you subtract these cost items from net sales, you come up with this line right here, profit from operations. This is a very important line. I'll be back to it in a minute, but first let's just finish the chart. The company makes a little money on the side. This is dividends and interest money from its own investments. So you add this money to profit, you get total income. Stretch also had to pay some, let's see, here, interest on bonds, set aside a little money for the federal government, taxes. So after you subtract, you get this bottom line item here, net profit for the year. Then you go to the very bottom line, this section here. This is net profit spread out over all the company's shares of stock, or earnings per share. Remember earnings per share? If you don't, you might want to roll back to segment 2. It's the E in PE. Now let's find out what Stretch's margin of profit is, which is, after all, why I came over here in the first place. We want to know if this company is becoming more or less profitable, or more or less efficient in its efforts to generate a profit. So going back to that line I told you was important, profit from operations. If you divide this line by the line net sales, you'll find both these lines on any income statement. You will find the company's margin of profit. Let's do it. $2,200,000 divided by 22 million works out to 10% exactly. That's their margin of profit, which means that for every dollar that this company generates in sales, it holds on to 10% or 10 cents as profit. Last year, the operating margin of profit, if you do the figures on that column, works out to only 9%. So on the basis of that comparison, we now know that not only is Stretch Rubber Band financially sound, which we learned from the balance sheet, but we now know that it is growing and becoming more profitable. So this company is not a bad investment, not bad at all. All right, I don't know about you, but that was a lot of information, so this is a good time to take a break if you want. I'm moving on, and we'll see you in segment number 4, or as we like to call it, fundamentals.
Only companies listed on the big board must issue a corporate report. True or false? False. Any publicly held company must issue a corporate report. Which of the following does not belong on a balance sheet? A, net sales. B, marketable securities. C, stockholders' equity. D, notes payable. The answer is A, net sales. If you want to find that, look on an income statement. If you divide operating profit by net sales, you get the operating margin of profit, or as it is also called, the profit margin.
Now it is time to take a look at all the different things that affect stock prices. What happens out there in the real world, in the economy, in business, in politics, has a major effect. But the trick is to figure out whether a given event will push prices up or down. And that takes us to the first type of market analysis, fundamentals. Now, the first thing you got to know, although this should come as no surprise, is that the market moves in cycles or in trends. And when we talk about trends, I am not talking about this. News events can send a market up or down for a day or for a week, but then things go right back to where they were. I am talking about major trends, the bull and the bear markets. These are the most important events on Wall Street. I want you to take a look at this chart. It's of stock prices going back to the turn of the century. And you can see major market upswings and declines. And the drops like this one over here, this is the Great Depression of 1929, the crash. This is called a bear market, called bear because the stock market is believed, like a bear in hibernation, to be going to sleep. And this is indeed a very big sleep. But now look what happens after World War II. It just creeps up, 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 up before leveling off in the 70s. This is a long upturn. This is called a bull market, called bull because the market, we like to think, is roaring or charging like a bull. Now, what makes the market go up or down is you, buyers and sellers. The stock market has a slogan where thousands vote every day, and that is exactly what happens. The exchange doesn't set the prices, you do. Thousands of investors voice their opinions with cash. Now, this is a buy order. So if on any particular day the pressure is heavy on the buy side, then prices will gradually go up. On the other hand, if the business of the day is heavy selling, these are lots of sell orders, then stock prices go down. Now, obviously, like all investors, what you want to do is buy when prices are low and sell when they're high. I mean, wouldn't you love it if you had bought down here at the bottom and sold somewhere up here on top? But to predict those magical moments, you've got to know where you are in a major trend, and you've got to guess which way the market's headed in the near future. And that is where fundamental analysis can help. A fundamentalist guesses where the market is going by tracking economic signals. Now, as a rule, when the economy is doing well, stocks do well. Although the stock market tends to run a little ahead, you may see the market turn up or turn down before you see a similar move in the economy. And that's because investors have already guessed what's going to happen, so they've already jumped in or jumped out early. Now, how do you make early guesses like that? Well, here are some fundamental signs that I think you should consider. Let's take a look. Production figures are important. And look for housing starts. People start building when the economy is improving. Keep an eye out for automobile production. It is very responsive to the economy and has a big effect on the market. Steel and crude oil production are also important business indicators, and you can also get monthly figures on factory use statistics and total manufacturing and mining production. All these figures are widely reported. Watch for them. They're on the financial pages, sometimes on the front page. A second important fundamental is money. How much is out there and who's got it? Business loans are important. They're reported every week. This is a sensitive signal because when businesses start to borrow, that usually means they're ready to expand or build up inventories. You should also watch the nation's money supply. It affects interest rates and inflation, which one way or another is going to end up influencing the stock market. The third important fundamental is sales. Retail sales are a good indicator of how consumers feel about the economy. When things look better, people spend more. It's a bad sign if they start spending less. Home purchases, auto sales, also important. All these sales figures are widely reported in newspapers, in every business magazine, and on television. Now, for the big picture. Watch the index of leading economic indicators. This monthly index takes a dozen key economic trends: housing starts, stock prices, money supply, new orders, interest rates, and it puts them all together, and this is one of the most useful forecasting tools available. Generally, it anticipates events in the economy by a couple of months. It'll rise just a few months before the economy rises, and it'll drop just before the economy slows. You'll find this index looking very much this way in the newspaper every month. All right, now these fundamentals are an early warning system, and I want you to keep this in mind when you use them. Because sometimes you'll be watching a major market trend that's kind of going along in one direction, and you'll notice that some of the indicators, like housing starts, money supply, the index, turn in the opposite direction. Watch out. This can't last. Something's got to give. and it's going to be the stock market. The stock market eventually falls in line with business activity. The market can't keep going up if business is falling off badly, and it won't stay down if business is going up. So when you see the indicators diverge from the market, you've got some decisions to make. It may be time to buy or sell. And also remember, keep an eye on the world outside.
Stock market prices are ultimately decided by A, news events, B, bull or bear markets, C, Congress, D, individual buyers and sellers. D is the answer. Individual buyers and sellers always determine the prices. The index of leading economic indicators is A, compiled by the government, B, found every month in newspapers, C, consists of 12 key economic indicators, D, all of the above. The answer is D, all of the above. If the market has been heading up for some time and business indicators start to decline, you can expect a continued bull market. True or false? False. The market tends to fall in line with business and will probably head down if business continues to decline.